We begin today with a developing story that is rewriting the risk calculus across energy, defense, and safe haven assets all at once. A UN-coordinated vessel evacuation plan for the Hormuz Strait has been placed on hold after a container ship was struck near Oman on Thursday, with U.S. officials directly attributing the attack to Iran. This is the first significant maritime incident since what was broadly understood to be a regional peace framework took hold, and it has caught markets in a moment of unusual complacency. The VIX sits at just 18.41, down 2.54% on the session, and that number may not hold if this situation deteriorates further. Here are the facts as they stand. A container vessel transiting near Oman was struck Thursday in what U.S. officials have attributed to Iranian action, the first kinetic maritime incident under the current peace accord framework. The United Nations subsequently suspended its coordinated Hormuz Strait Evacuation Corridor plan, a mechanism designed to keep commercial shipping moving through one of the world's most critical energy choke points. Roughly one-fifth of global oil supply moves through this strait daily. WNT offshore crude is currently trading at 69.23, down 3.74% on the session, while Brent sits at 72.60, off 3.53%. Movements that reflect, for now, a market still betting on containment rather than escalation. The deeper issue here is not just one ship. It is what that ship represents for the market's embedded assumptions. Wall Street had priced in a sustained period of calm in the Persian Gulf following the peace accord framework, treating the Hormuz corridor as effectively open for business with minimal disruption risk. Energy prices reflected that consensus, and geopolitical risk premiums had been systematically wrung out of equities and oil alike. This single incident ruptures that narrative. The fact that it happened under an active peace deal means markets now face an uncomfortable question. Was the de-escalation durable, or was it a temporary lull that Iran has just chosen to end? That uncertainty reprices everything. Let's run through the transmission channels. Energy is the most direct, WNT offshore at 69.23 and Brent at 72.60 are the levels to watch right now. Any confirmed escalation flips these from losses to sharp gains as supply disruption fears take over. Gold at 4,096.30, already up 1.63%, is behaving exactly as a safe haven hedge should. The 10-year Treasury yield at 4.37% faces downward pressure on further flight to safety buying. Defense contractors are the clearest beneficiaries. RTX Raytheon, Lockheed Martin, and Northrop Grumman all stand to outperform as geopolitical risk and defense spending expectations reset higher. Container shipping lines like ZM face direct route exposure. The S&P 500 at 728.99 and the Nasdaq 100 at 706.52 are vulnerable if the risk premium reprices upward. There are 4 levels every trader should have on their screen right now. First, WNT offshore crude at 69.23. A break above 75 would signal that supply disruption fears are being priced in earnest, not just speculated. Second, the 10-year Treasury yield at 4.37%. A break below 4.15 would confirm an accelerating flight to safety bid that would pressure equities meaningfully. Third, gold at 4,096.30 with 4,200 as the next overhead resistance and psychological target if geopolitical stress deepens. Fourth, and perhaps most important right now, the VIX at 18.41. That reading is dangerously complacent given a live maritime incident attributed to a state actor in the world's most critical oil choke point. Watch for a rapid VIX repricing if additional attacks materialize. Here is the bottom line. The pause in the UN Hormuz evacuation plan after Thursday's Iranian-attributed strike is not just a diplomatic setback. It is a direct challenge to the peace premium that markets have been quietly accumulating for months. With WNT offshore at 69.23, the 10-year yield at 4.37%, and the VIX at 18.41, the risk complex is priced for continued calm. But a single additional attack could trigger a rapid repricing across oil, rates, and equities simultaneously. Investors should hedge long equity exposure tactically, add gold and long-dated treasuries as ballast, and consider overweighting defense names like RTX, Lockheed Martin, and Northrop Grumman. The market is underpricing this tail risk, and that gap closes fast when headlines move. That's the full picture on the Hormuz situation. Coming up next, a major story moving global bond markets. Shifting now from domestic markets to a geopolitical shock that is reshaping risk pricing across every asset class this morning. The United States military has confirmed it conducted retaliatory strikes against Iran, following Tehran's Thursday drone attacks on ships transiting the Strait of Hormuz. President Trump characterized those attacks as a direct ceasefire violation, and the Pentagon responded with force. This is not a diplomatic warning or a proportional posture signal. This is live military engagement between the United States and Iran, and markets are beginning to price the tail risk that comes with that reality. Here is what we know with precision. Iran launched drone attacks on commercial vessels in the Strait of Hormuz on Thursday. The United States military then conducted retaliatory strikes against Iran in direct response. President Trump framed this as a ceasefire violation, meaning Washington's own rules of engagement were triggered. The Strait of Hormuz is the single most critical oil choke point on Earth, responsible for a substantial share of global seaborne crude flows. WNT offshore crude sits at 69.23, down 3.74% on the session, while Brent is down significantly. A counterintuitive reaction we will explain in the next frame. The reason this matters beyond headlines is structural. Wall Street had been operating under a working assumption of relative stability in the Strait of Hormuz following ceasefire arrangements. The consensus had assigned a low probability to direct U.S.-Iran military exchange. That consensus is now broken. This is a binary geopolitical event, not a data release with a forecast baseline. The paradox of oil falling is actually rational. Markets are pricing a demand destruction scenario if escalation disrupts global growth, while simultaneously bidding gold too. 4,096.30, up 1.63%, as the classic flight to safety trade activates. Silver is also strengthening, reinforcing the safe haven bid. Let's run the asset map precisely. Energy. The energy sector, along with integrated majors like Chevron and ConocoPhillips, sits on the beneficiary side if crude reprices higher on supply disruption fears. WNT offshore at 69.23 is a critical support level, and a move above 75 would signal genuine supply premium pricing. Defense contractors Lockheed Martin, RTX, and Northrop Grumman absorb tactical demand premiums in elevated tension environments. Long-term treasuries. The 20-year Treasury ETF benefits as the flight to safety bid strengthens. The 10-year yield has already dropped to 4.37%. Meanwhile, the Nasdaq 100 is the clearest loser, down 1.38%, as risk-off sentiment dominates and rate cut timelines get pushed further out by geopolitical uncertainty. The key levels to monitor are specific and consequential. WNT offshore crude at 69.23 is your pivot. A break below 65 signals the market is pricing demand destruction over supply disruption, a deeply bearish macro signal. A break above 75 signals genuine Hormuz supply premium repricing and would accelerate the energy and defense rotation. The 10-year Treasury yield at 4.37% is the safe haven barometer. Watch for a move toward 4.25% if risk-off deepens materially. Gold at 4,096.30 is establishing higher lows, with resistance at 4,150. Most critically, the VIX at 18.41 remains below panic territory. A breach above 22 would signal the market is no longer treating this as a contained escalation. Here is the bottom line for traders and portfolio managers watching this unfold. The VIX at 18.41 is telling you something important. Institutional positioning does not reflect panic, it reflects measured concern. That gives you a window. If WNT offshore holds above the current level and geopolitical premium widens further, the rotation is clear. Increase exposure to energy and defense while trimming duration risk in long-dated bonds like long-term treasuries. If Iran does not respond and de-escalation signals emerge, crude sells off further. The S&P 500 and the Nasdaq 100 stabilize, and the flight to safety bid in gold and treasuries unwinds rapidly. Those are the two stories that matter most today. Full breakdown is up. If this kind of deep dive market analysis is what you need every trading day, hit subscribe right now and tap the notification bell. We break down the stories that actually move your portfolio every single session before the open.